Assalamu Alaikum everyone, welcome back to another video. I hope you're having a great day. In today's video, I'm going to share with you 5 high-tech dividend stocks to buy and hold forever. If you are constructing a new portfolio or you already have one that you want to you are putting together still, then this video is great for you. The reason I said that is because when we look at the S&P 500, okay, generally, because remember the tech companies in this have actually the S&P 500 actually helped over the last 5 to 10 years, if not longer, to actually get the returns that we've seen. What I mean by that is, so we've got about 11 different sectors in the S&P 500. Yeah. Okay, so you got the consumer discretionaries, you got the stables, you got energy, financials, healthcare, industrial, information tech, materials, real estate, communication, utilities, and so on. Right. So when we look at the technology, right, a year to date is down quite a bit, 26%, almost 20, let's say 27%, right? But a year before, okay, in 2021, the returns on this sector. So imagine if you bought the ETF that tracks all the companies in the S&P 500 that are just tech companies, you would have made about 35%. A year before that, almost to 44%. 50% a year before that. 2018, it wasn't great. It was minus 0.3, so not a lot. Okay, it wasn't down a lot. 30, almost 9% in 2017. 13%, 6%, 10, 20%, 28%, 14%, almost 15%, 2% there, 10%. 61%, almost 62% there. And then in 2008, was the year, obviously, the financial crisis and all that stuff. And that year they were down about 43%. And a year before that, it was about 16%. So generally, they have outperformed the general markets. There's no other sector close to this sector. And this is one of the reasons Obviously, I understand the tech side of things a lot better than I do the, let's say, materials, for example, right? But this is one of the reasons I'm bullish on this tech sector, because of the returns that we've seen. These companies are very innovative. They are the reasons why we are communicating right now, like YouTube and all of these places, okay? Because they allow us to do these things, and they are changing the world and the way we see things. So every single portfolio should have companies that are in this sector. Before I get to the video and talk about the companies that I want to talk about today, there's another thing I want to mention, and that is the earnings. The earnings report started last week. I think it was the Levi's that reported last week, and that was a good earnings. But one of the things I'm looking at in the next 2 to 3 weeks is just to pay attention to what these companies say, because a lot is riding on this, because we've had the recession talk, we've had issues with inflation, we've had the war, all of these things going on. Now we need to look at if these companies are actually making profit. The forecast is for the next couple of quarters actually better than what we thought, and that will change the markets. Okay, if these companies come out and they predict their earnings is going to decline, or something is going to happen, or supply chain situation is still going on, then we are in trouble. So the companies like PepsiCo is reporting on Tuesday before the market opens. Okay, you've got Delta Airlines, you've got all the banks, you've got TSMC as well reporting, you've got the JP Morgans and so on. So pay attention to what's going to happen in the next few weeks. Okay, because the week after, I think, is the big boys, the Microsoft, the Apples and Amazons and Teslas. I think is that week, or is Microsoft and Tesla, I think, reporting that week. And then the week after, the big boys again. So these earnings reports are really, really important. And the market is definitely going to be volatile. If any of these big boys, especially Apples and Microsoft, because of how much the weightings are on the S&P 500, we could see a decline of maybe 5 to 10%, if not more, if the earnings are not going the way they should be going, to be honest, and that's upwards. So just pay attention to what's happening on the overall market. But let's go back to what we're talking about today. So there are 5 different companies I want to share with you today. And the first company I want to share with you is definitely Microsoft. You know Microsoft, how I feel about Microsoft. Is one of the biggest companies in the world. Okay, $2 trillion company. They have amazing net income, profit margins, and return on equity. And they have $63 billion of free cash flow. So this is one of the companies I absolutely love. The beta is not that big, which is quite nice. Operating margins is great. Sales, $192 billion of sales per year. That is ridiculous, okay? And if you hold this business for the last 10 years, you would have made about 31% total as a total return. And when you look at their 2019 to right now, where they are in terms of the total revenue, you can see $125 billion to right now $192 billion. And this is one of the reasons I absolutely love this, and the fact that they're very innovative. They are not just going to sit around and keep that cash and do nothing with it. They reinvesting that back into the business. They're paying us dividend. They're buying back their shares and so on. Okay, so gross profit is really good. Look at the EBITDA from 58 to right now $85 billion. And they still pay you some nice dividend. Right now, it looks like it's about 24% discounted right now, according to Morningstar. According to Simply Wall Street, is say 36%. Tip ranks about 30%, and so on. And it definitely, for the next 5 years, Yahoo Finance are expecting basically this earnings to grow about 16% every single year. Okay. And that is really one of the reasons that I absolutely love this business. And the fact that year to date it's done nothing other than they basically lost about 21% of basically in terms of the price appreciation. Now, the other thing I want to quickly show you is they're buying back their shares. Okay, so let's have a quick look. So earnings per share is growing. So from 2012, okay, to right now 2020, so the next basically 12 months, look at from $2.78 to right now, basically the prediction for the next 12 months is about $10, from 2 to basically almost 10. And when you look at free cash flow per share, $3.5 to right now $8.5. So it's really, this business is absolutely amazing, and I don't think it's going to slow down in the next few years. And one thing I want to share with you is this bit here, because as much as they pay as dividends, okay, it's also important that these companies buy back their shares, especially when they are, some companies actually issue more shares, and that's not a problem if the company is still growing. A company like Salesforce, they actually, because their shares are too expensive, sometimes they sell more shares so they can actually use that to reinvest in the business and so on. And I don't mind that because they are still in the growth phase, right? But company like Microsoft, if they were diluting our shares, I would be worried. Okay, we want this to decline from 8.51 to right now 7.56. So it's really good. And then look at the total sales is actually heading the right direction. This is one of the reasons I absolutely love this business. Next company is MasterCard. MasterCard is one of those businesses people think is not Sharia compliant, but they don't actually do anything transaction wise. Their main job is to create the technologies that allows people to do those transactions. Okay. So right now, as you can see here, they are $314 billion company. And as you can see, their net income is great. Profit margins are absolutely amazing. And return on equity is over 138%. They've got about $8.8 billion of free cash flow here. One of the things I genuinely like about this business, again, is similar sort of a Microsoft, okay? About $15 billion to right now about $19.8 billion of total revenue. The EBITDA from 7 to 11. Free cash flow from 5 to $8 billion. Then it still pay a little bit of dividend. It's not a lot, 0.61% of dividends, okay? It's not great, but the payout ratio is very small. And if you're quite young and you really want a company that's going to be around for a very long time and definitely going to increase that dividends, look at this 5-year growth rate, that about 18%. So they're growing at about 18%. The payout ratio is very, very low, and they have actually increased this basically for 15 years, and their dividend safety is 100%. So a company that is so profitable that they're making so much cash, okay? And the other thing as well is what they're doing with that cash. That's the most important thing. Obviously, they're paying as the dividends, but at the same time, earnings per share from $2.20 to right now 10. It actually kind of looks like Microsoft, okay, in terms of that side of things. And then price to free cash flow is free cash flow per share is also very similar, okay, 2.18 to 8.96 per share basically. Okay, and the final thing I want to show you about this company is basically the shares outstanding. Now, as you can see, it's declining. For the last 10 years, they have been buying their shares back, which is very good. So they've probably gone through a stage where they were actually diluting their shares because they want to grow the business. But right now, they're buying it, aggressively buying it back, which is very, very nice to see. And total sales is definitely increasing in the right directions. Okay, from basically $7 billion to right now about almost $20 billion in 10 years. So that's the kind of business that I definitely want to own in my portfolio. Unfortunately, I don't have MasterCard. I do own Visa. But it seems very attractive right now because when we look at the valuations, we're looking at about 12% discount right now, according to Morningstar. Simply Wall Street about 13, 17 according to Ranks. So it's actually, and the fact that it's going to grow the business-wise and earnings-wise, 23%. It's really attractive again. Ideally, I would have loved if this was about, say, in the 20%. I wouldn't mind getting back into it. I sold it recently, took some profit because I do own Visa. So for that reason, I took some profit off the table. So we'll see. You might see this again in my portfolio, but it's one of the best companies out there, and I'm sure their earnings is going to grow faster in the next couple of years. The next company we're looking at is one of my all-time favorite companies, and that is Broadcom. Broadcom actually supplies various semiconductor devices in terms of mobile phones and other devices as well. When you look at their net income, profit margin, and return on equity is absolutely brilliant. And to have this company to have free cash flow of almost $14 billion, and it has a market cap of basically just over $200 billion. The PE seems a little bit high, okay, but price to sales is really low. And when you look at the difference, look at this. According to this website that I'm using to get this information from, EPS is expected to grow almost double. Basically, it's going to double their EPS. So that will be interesting to see if it really happens. Beta is a little bit higher than what I expected, but that's fine because this is a high growth business, and operating margins is really good, and sales is about almost $30 billion. And if you hold this business in the last 10 years, you would have made almost 35% of your investment. Now, in terms of growth in the revenue side of things, okay, we're looking about 2018, almost, $21 billion to right now almost $30 billion. And when you look at the EBITDA from $9 to $14 billion and free cash flow from $8 billion to $14 billion. And it does have an amazing dividend. Look at this. Dividend yield of 3.3, over 3% for a company that's growing their business that fast. Okay, so their dividends right now is about $16 for every share of this business that you own. The payout ratio is slightly high, 73. In fact, I want to check that because, I'm not sure if that's true because according to Simply Save Dividends, is about 50%. So that's fine. For me, that's absolutely fine. And they have increased these dividends for 11 years. The other thing I want to quickly show you about this company is this, okay? When you look at their earnings per share from $2 to right now, almost $40, right? Free cash flow per share from $1 to now 34 basically dollars. That's huge growth. That is huge. That's absolutely. I wish I bought this company when it was in 2012 because it would have made a lot of money. Then one of the things they're doing right now, they've done quite a bit, is basically they've been diluting their shares to grow the business, but they started buying back their shares now. So from basically next 12 months, they've already said they are going to buy back their shares, which is absolutely brilliant. And the total sales from $2 billion to $30 billion in this space of 10. Now, one of the things that you need to think about if you're interested in this business is they buy other companies, so they acquire other businesses, so they grow in the business organically, but they also acquire so many different businesses. And I think they recently actually I think it's VMware that they're actually interested or basically about to buy. So we'll see if that deal goes through. But as you can see here, it's discounted about 20% right now, according to Simply Wall Save Dividend Morningstar. Simply Wall Street is about over 30%. Tip ranks about 23%, and growth into the next 5 years expecting about 15%, which is absolutely amazing. Right, if you're still watching, I would really appreciate if you can give the video a like. If you haven't, subscribed to the channel yet, please do share it with your family and friends. Like I've always said, all I'm trying to do here is kind of help other people out there, genuinely just share my journey and so on. Right, so let's have a look at the next company, and that's Qualcomm. Qualcomm is one of those businesses that I own in my portfolio. It has a market cap of $152 billion. The net income is great, profit margin and return on equity absolutely amazing. They have $7 billion in the bank too for free cash flow. And look at this PE. It's a tech company, but right now it's got PE of 14 only. Price to sales only 4 basically right now. EPS, we're looking about let's call it 10. Okay, $10 right now, and next basically year is expected almost at 13. Right, that might happen or might not happen, but that's the expectation. Okay, the other thing I want to share very quickly is the growth in terms of the total revenue from basically $22 billion to right now almost to $40 billion. And when you look at the EBITDA from $2 to $12 billion, free cash flow from $3 to $7 billion. You don't see that kind of thing. And the company has 2% dividend yield. They pay you $3 for every share you own, and the payout is very low, and the 5-year growth rate about 6%, and the dividends of safety is basically 80%. Dividend streaks is basically 18 years, so they have increased that dividend for 18 years. It's discounted right now, according to all of these companies, is one of my long-term holdings, and it's expected to grow about 14%. Now the other thing I want to show you is the shares outstanding. So let's go and look at that. But before we do that, look at the earnings per share. Is actually growing and heading in the right directions. Price to free cash flow per share is actually gone down a little bit here, as you can see, but that's nothing to worry about. It's fluctuated here and there. This is one of the companies as well that buys other businesses, so that could basically explain that. I'm not really sure, but when it comes to shares outstanding, from 1.74 billion to right now 1.14 outstanding shares. So it's definitely buying back their shares aggressively, which is really nice. And the total sales is actually growing and heading in the right directions. Now, this is another great company. You're getting about 2% dividend yield. So if you are looking for a tech company, okay, that is going to be around for a very long time and it has over 2% dividend yield, then this is definitely a company to look at right now. If you have a mobile phone, they definitely have their chips in there at some point, whether it's a Microsoft, whether it's the Apple's phone, or whether it's a Samsung. This company provides the chips that go into that business. And the final company we are looking at is Visa. Visa is one of those businesses that I feel like I've ignored this stock in my portfolio. It is definitely in my portfolio, but I haven't actually done anything to it for a while. I bought 10 shares and I left it there. I feel like I neglected. It's down quite a bit, about 6% for the last 3 months. But when we look at the for the 1 year, it's actually down only 14%. So I might start looking again just to see if I can add to this company. But it's one of the best businesses out there. PE is quite high. That's one thing that kind of really makes me feel like there's better companies out there right now, probably cheaper companies, not better. Okay, they have a market cap of $430 billion, right? Net income is great, profit margin is perfect, return on equity absolutely amazing, and they have $15 billion in the bank right now to use for whatever. Dividend is not great, but it's there at least, okay, just below 1%. Payout ratio is very low, so they have room to grow, and they definitely growing that dividend, because look at that 5-year growth rate of 15%, and they have a 99% safety, and they have increased that dividend for 14 years. In terms of the revenue, we're looking about $20 billion to right now $26 billion, almost $27 billion right now. EBITDA again $14 to $17 billion. Free cash flow from about 12 to right now $15 billion. Is down just not a lot this year. So for the basically a year to date is about just 6%. That's probably one of the reasons I'm still holding on. I don't want to add to it yet. I think I want to see at least maybe another 4, 5 to 10% pullback again. Morningstar is saying it's about just 11% discounted right now. If that was 20 or more, then I'll maybe look at it again. Simply Wall Street valuation, it says about almost 18%. Tip ranks about 24%, and their price targets are 264, 221, 262, and 260. So in the 260s, basically that's what they're expecting. Next 5 years, you can see about 18% growth of earnings every single year, and it definitely has a wide mode. So let's quickly have a look at their shares, what they're doing to their shares. So earnings per share is definitely increasing. Free cash flow per share is definitely increasing, and the shares buyback, absolutely buying back their shares. So they've definitely gone through a stage where they were increasing, but then right now 2.67 to right now 2.17, and total sales, as you can see, is also heading the right directions. So if you're looking for a quality businesses that are going to be around for a long time, and when you look at companies like MasterCard and Visa, trust me, right now just look at your pocket. You've got definitely one of those cards that these companies issue. Look at Microsoft, is not going anywhere. Qualcomm and Broadcom are actually in the mobile industry, as well as all the Wi-Fi stuff, everything that basically needs to be connected. These companies have a product for it, and Qualcomm has so many patents that actually other companies like that Nvidia actually uses. They get paid by these companies because they actually hold the patent for these type of patents, for example. So yeah, they are absolutely amazing companies, and that's one of the reasons I own basically 4 out of the 5. I do own Broadcom there. Just 5 shares is one of the companies I'm planning to add to next few weeks. I own Microsoft, as you can see there. I own Qualcomm, and obviously I own Visa as well. The only one that I don't own in that list is MasterCard, and I did own before, and I've sold it not long ago, because one of the reasons I actually sold it was because Visa, if Visa goes down 4%, MasterCard went down with it 5%, and exactly the same. They were mirroring each other every single time. So at the time was too much volatility. I felt like it wasn't ideal to hold that, and I just want to reduce my risk of the portfolio. Was actually very, very volatile at the time, so I had to reduce that. But in the long run, you never know, I might actually buy them back again. Just MasterCard. Right, that's the video. I didn't want to make it this long, but it is. So keep an eye on the earnings next week. I think that's really important, because you might see a lot of the companies that you want to add to or buy more of or whatever being actually hit hard really next couple of weeks. So just pay attention to that. We'll see what happens, inshallah. Assalamu alaikum. Take care.